Dogs of the Dow is an investment strategy that attempts to beat the Dow Jones Industrial Average each year by leaning portfolios towards high yield investments. The general idea is to allocate money to the 10 highest dividend yielding blue chip stocks among the 30 components of the Dow Jones. The strategy requires rebalancing at the beginning of each calendar year. Because the Dow is one of the oldest and most widely followed indexes in the world, and generally is seen as a barometer of the broader market, it is not uncommon for market strategists to base investing techniques on some components of the Dow Jones. The main reason to follow dogs is that it presents a straightforward formula designed to perform roughly in line with the Dow, and in theory, outperform it. Though not entirely a new concept, the strategy first became popular in 1991 following the publication of the book Beating the Dow. The logic behind this investing strategy is that larger blue chip companies tend to not change their dividend to reflect trading conditions, and as such, the dividends can be used as a barometer to measure the average worth of a company. In contrast, the stock price of a company might fluctuate throughout the business cycle. This should mean that companies with a high dividend relative to stock price are near the bottom of their business cycle, so their stock price likely would increase faster than companies with low dividends. In this scenario, an investor reinvesting in high dividend yielding companies annually would hope to outperform the market. The process of following the Dogs of Dow investing strategy is simple. Find the 10 highest dividend yielding stocks in the Dow Jones Industrial Average and invest an equal dollar amount in each of them. Then hold your positions for at least 1 year in order to receive the very favorable tax treatment of long-term capital gains. Once the year is up, repeat the process and rebalance your portfolio with the current year's 10 highest dividend yielding stocks in the Dow Jones Industrial Average. This process is very easy and hands-off approach that can be done in a matter of minutes. And while results are never guaranteed, the Dogs of the Dow has shown strong overall results in the past. So let's dive in and explore the current 10 highest dividend yielding stocks that comprise the Dogs of the Dow as of today. Coming in at number 10 is JP Morgan Chase with its 2.77% yield. JP Morgan may be a good stock pick as fear of a complete financial meltdown slowly subsides due to a slowing or pausing of interest rate hikes. Additionally, JP Morgan has been on a quest in recent years to buy back a total of $30 billion worth of shares. This indicates that leadership within the company, who knows the inner workings of the company best, feel that the company is financially strong and that it is therefore advantageous to buy back shares at the current prices. Number 9, Cisco Systems with its 3.06 dividend yield. Cisco is the global leader in high-performance computer network systems. The company's routers and switches allow networks worldwide to connect to each other through the internet. Cisco also offers data center, cloud, and security products. Cisco offered a revised outlook for the fiscal year 2023 as well. The company now expects revenue growth of 9% to 10.5% compared to only the 4.5% to 6.5% that was estimated previously. Adjusted earnings per share is now expected in the range of $3.73, compared to about $3.51 previously. At the midpoint, this would be roughly a 12% improvement from the prior year. Number 8, banking juggernaut Goldman Sachs, with a dividend yield of 3.17%. Like most banking stocks, Goldman Sachs prices has taken a beating lately with the failure of Silvergate and SVB banks, and a fear of a broader contagion in the banking industry as continually higher interest rates imposed by the Fed are putting pressure on long-term bond values that banks typically like to invest in. This caused a fairly serious 25% decline in the stock price of Goldman Sachs in only a month's time. However, with the Fed signaling a slowing of additional rate hikes, we are likely at or near the peak interest rates, which means that things will likely only get better from here, which could indicate a prime buying opportunity for Goldman Sachs stock. Number 7, Amgen Inc., with its 3.9% yield. They're the largest independent biotech company in the world. and they discover, develop, manufacture, and sell medical devices that treat serious illnesses. The company focuses on 6 therapeutic areas: cardiovascular disease, oncology, bone health, neuroscience, nephrology, and inflammation. They generate roughly $26 billion in annual revenues. Prolia, which treats osteoporosis, has become the top growing product for Amgen this year, as volume increases by 14% year over year, as well as a markup in the base price. Number 6, Chevron Corporation with the stock ticker CVX and its 3.92% yield. As one of the leading oil companies, Chevron has benefited greatly from record refining margins, which resulted from sanctions of Western countries on Russia for its invasion of Ukraine. As a result, they were able to grow their adjusted earnings per share by 60% from $2.56 to $4.09. Chevron also raised its dividend by 6% and announced a massive share repurchase program of $75 billion, or roughly 23% of its current market cap. With the war in Ukraine unlikely to end anytime soon, it is expected that gas prices will remain elevated through the year, greatly benefiting the company. Number 5, IBM with a 5.03% yield. IBM is a global information technology company that provides integrated enterprise solutions for software, hardware, and services. IBM's focus is running mission-critical systems for large multinational customers and governments. IBM typically provides end-to-end solutions. The company now has 4 business segments: software, consulting, infrastructure, and financing. IBM had an annual revenue of $60.5 billion in 2022. Number 4, Dow Inc., stock ticker DOW, with its 5.27% yield. While the Dow company is of no relation to the Dow Jones Industrial Average, Dow Inc. is a spin-off of the former parent company Dow DuPont into 3 separate companies, with its material science division now making up Dow Inc., creating a wide variety of chemical products such as plastics, silicones, solvents, resins, foams, gels, and adhesives. Basically anything you need in the manufacturing world. Number 3, 3M Company, stock ticker MMM, with a 6.17% yield. 3M sells more than 60,000 distinct products that are used every day in homes, hospitals, office buildings, and schools around the world. 3M is now comprised of 4 separate divisions: safety and industrial, transportation and electronics, healthcare, and consumer business groups. The company has suffered in recent years due to an ongoing class action lawsuit regarding earplugs manufactured from the U.S. military that plaintiffs claim were largely defective. This has caused a fairly severe reduction in overall share price. This may cause 3M to be an attractive buy option, as an unfavorable result in the courts will further drop share price, but probably not by too much, since the market has already largely factored this lawsuit into the current price. However, a relatively favorable result for 3M, either through a smaller than anticipated fine or a dismissal of the case entirely, could lead to a significant uptick in share price. Number 2, Walgreens Boots Alliance, stock ticker WBA, with 6.6% yield. Walgreens is the largest retail pharmacy in both the United States and Europe. The company employs more than 315,000 people and has more than 13,000 stores. While adjusted earnings per share have dropped 27% year over year, this is largely due to high COVID-19 vaccinations, boosting revenue in the prior years. The company has now beaten analysts' estimate for 11 consecutive quarters, indicating that management is navigating the company well through these challenging economic times. Last on the list of dogs of the Dow, the current king of dividends within the Dow Jones Industrial Average, clocking in at a whopping 7.27% yield, is none other than Verizon Communications, stock ticker VZ. Verizon is one of the largest wireless carriers in the U.S., covering 98% of the country and serving 300 million people globally. Wireless services contribute 75% of total revenue, while broadband and cable services account for about a quarter of sales. 5G ultra-wideband has already been launched in several cities, and rollout plans continue in other metro areas. Current guidance from Verizon expects adjusted earnings per share to decrease by 7% from prior year. But this isn't necessarily out of the ordinary considering the large expense costs of upgrading infrastructure to support the 5G network. This infrastructure upgrade is a short-term expense that will help lead to a long-term profit. So what are your thoughts on the dogs of the Dow investing strategy? Leave a comment down below with what you think. If you enjoyed the video, consider subscribing, give it a thumbs up for the YouTube algorithm, and as always, I'll see you all again next time. Thanks.